Welcome back to Beyond the Benchmark. I'm Ryan Kasper. Economic data remained sparse this week as the federal government shutdown dragged on, but one key number did make it through: the Consumer Price Index. Inflation came in a bit cooler than expected, with headline CPI rising 0.3 and core inflation up 0.2 for September. That's still elevated, but it's progress. Gasoline prices rose sharply during the month, while shelter costs, a major driver of inflation, notched their smallest increase in 5 years. Year over year, both headline and core CPI sit right around 3%, which keeps the Fed on track to begin easing in the weeks ahead. That CPI print was more than just a market talking point. It's also the figure that sets next year's Social Security cost of living adjustment, which will rise 2.8% in 2026. A good reminder that inflation touches everything, from policy to personal finances. Private sector data helped fill some of the gaps left by the shutdown. The S&P Global Manufacturing and Services PMIs both surprised to the upside, signaling continued economic growth as we start the fourth quarter. Manufacturing ticked higher to 52.2, while services climbed to 55.2, both comfortably in expansion territory. The commentary from S&P was cautiously optimistic. Business activity is accelerating, but confidence in the outlook is fading as companies worry about tariffs and policy uncertainty. On the housing side, existing home sales rose modestly in September, up about 1.5%, with stronger activity in the West and South. The National Association of Realtors pointed to improving affordability as mortgage rates dipped to around 6.33%, but that's still well above where many current homeowners locked in. Consumer sentiment, meanwhile, continues to struggle. The University of Michigan Index fell again in October, down to 53.6, with Americans still uneasy about inflation and future job prospects. Turning to markets, equities rose globally last week. The U.S. and emerging markets led the way, with the S&P up nearly 2% and small caps gaining even more. Tech, energy, and industrials were the strongest sectors, while defensive names like utilities and consumer staples lagged. Overseas, Europe and Japan were mixed, while the UK and emerging markets fared better, helped by easing inflation readings and tech momentum in South Korea and Taiwan. Bonds posted modest gains, particularly in U.S. credit, as yields stabilized and the curve stayed relatively unchanged. The stronger dollar weighed on foreign debt, but didn't derail overall performance. Commodities were broadly higher. Oil jumped more than 6% for the week after new U.S. sanctions on Russia raised concerns about supply disruptions, even as global inventories remained solid. The big picture this week: inflation is cooling just enough to keep the Fed on its easing path. Growth remains resilient despite Washington gridlock, and markets are responding with cautious optimism. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. Stay disciplined, stay informed, and we'll catch you next week.